Every day, government facilities in Washington, D.C. produce more than $500 million in physical cash to satisfy the country's demand for paper currency. But those bills account for a small fraction of the total money moving through the economy. Most of our wealth exists as digital records, and that supply expands by more than $4 billion every day through entries at financial institutions. We often view our savings as physical deposits sitting in a secure building, waiting to be counted out and withdrawn. This ability to expand the money supply through keyboard entries raises a question about why the system stays stable rather than collapsing. Understanding this requires looking past bank logos and federal buildings to the root of currency, a ledger of shared trust. Thousands of years ago, a farmer needing a tool before his harvest could only offer a promise of future value in exchange for work today. To scale trade, communities began using commodities like salt, grain, or cattle, items with universal utility that could settle debts immediately. Small metal coins eventually replaced bulky goods, allowing merchants to transport wealth across continents in durable containers. By the 17th century, the weight and risk of transporting large quantities of gold led merchants in London to seek out secure storage. Local goldsmiths took in the metal and issued paper receipts, promising to return the gold to anyone who presented the note. These receipts became more convenient to trade than the gold itself. Because merchants rarely withdrew all their gold at once, goldsmiths began loaning out additional notes for gold they didn't actually have in reserve. This created a system where the total value in circulation exceeded the physical resources held in the vault. In a closed system with fixed currency, 4 people can trade if distribution remains balanced. If one person accumulates the cash, others can't participate, and trade stops. Adding new currency through a loan restarts the cycle, providing the capital to reactivate trade between participants. Modern commercial banks operate on this exact principle. When a bank issues a loan, they don't transfer someone else's savings, they create new digital units in the borrower's account. That new money pays for a car, then flows to a dealership and its employees, facilitating a chain of transactions that would have been impossible with a static supply. Debt functions as the primary mechanism for injecting capital into the modern world, funding the expansion of businesses and infrastructure. This system requires a balance. If banks create currency faster than society produces goods, prices rise as more money competes for the same products. To maintain stability, commercial banks rely on the central government as the ultimate source of currency. The government generates massive sums through the sale of bonds, which are loans that provide a steady return to investors. Selling these bonds provides the capital the government uses to fund its budget, paying corporations and citizens for their work. Because the state spends more than it collects in taxes, it remains in a cycle of borrowing to cover its obligations. This model of perpetual borrowing supports the expansion of most modern economies. The system remains sustainable as long as that capital is directed toward development, such as building energy grids and improving education. Modern money acts as a ledger of human promises, scaling with our ability to build and innovate for the future.